Wealth is built by not spending what you earn, but by investing it. Robert Kiyosaki. These words ring true to many, particularly in the realm of wealth creation, a topic that has been the subject of much debate and speculation. Today, we delve into the controversial perspectives of two financial titans, Robert Kiyosaki and Warren Buffett. Kiyosaki, a self-made millionaire author and advocate for financial education, champions the idea of aggressive investment as a means to amass wealth. On the other side of the spectrum, we have Buffett, the Oracle of Omaha, a seasoned investor with a reputation for his slow and steady approach to wealth building. Both these individuals, with their vastly different strategies, have left indelible marks on the world of finance. They have inspired millions with their success stories and have become the embodiment of their respective investment philosophies. But who's right? Kiyosaki with his aggressive investment strategy, or Buffett with his slow and steady approach? Kiyosaki believes in making money work for you, not the other way around. He champions the idea that financial freedom doesn't come from working a 9-to-5 job, but rather from understanding how money works and leveraging it to your advantage. A cornerstone of Kiyosaki's wealth-building approach is financial education. He asserts that understanding the nuances of money, investing, and markets is key to wealth accumulation. However, this knowledge, according to him, isn't found in traditional educational systems. He often points out the lack of financial literacy programs in schools, leading to a society ill-prepared to manage money. Kiyosaki also places great emphasis on real estate investments. He suggests that investing in properties can provide both a steady cash flow and potential capital appreciation. His philosophy banks on the idea that owning assets that generate income is a more reliable wealth-building strategy than relying on a paycheck from employment. Creating passive income streams is another pivotal aspect of Kiyosaki's approach. He advocates for the creation of businesses or investments that require minimal ongoing effort, yet generate income. This could be royalties from a book, dividends from stocks, or rental income from properties. However, Kiyosaki's views are often seen as controversial. His dismissal of traditional education and employment has been met with criticism. Critics argue that not everyone has the resources or risk tolerance to dive into investments or entrepreneurship. They suggest that stable employment and a steady paycheck provide a safer, more reliable path to financial security for many people. Despite the controversy, Kiyosaki's approach to wealth building has resonated with many. His book, Rich Dad, Poor Dad, has become a bestseller, shaping the financial perspectives of millions around the globe. His message is clear. Financial literacy, investment, and creating passive income streams can lead to financial freedom. For Kiyosaki, it's all about taking risks and being in control of your financial destiny. With his philosophy, he challenges conventional wisdom and encourages individuals to chart their own path to wealth. Buffett, on the other hand, advocates for a slow and steady approach to wealth building. Known as the Oracle of Omaha, Warren Buffett's journey to opulence is a testament to the power of compound interest and the value of time. Rather than seeking quick returns, Buffett's strategy is rooted in the principles of value investing. This approach involves buying stocks at a price below their intrinsic value and waiting for the market to recognize their true worth. In essence, it's about finding bargains in the stock market, much like shopping for discounted items in a department store. Buffett's strategy is about buying good businesses at reasonable prices and then holding on to them for the long term. But it's not just about buying and holding. Buffett is also a firm believer in investing in what you know and understand. He's often quoted saying, "Never invest in a business you cannot understand." This philosophy has guided him towards investments in companies with simple business models and strong competitive advantages. From Coca-Cola to Apple, Buffett's portfolio is filled with companies that are easy to understand and have stood the test of time. Another cornerstone of Buffett's approach is his emphasis on patience. He often likens investing to a game of baseball where there are no called strikes. Investors can wait for the perfect pitch before swinging. This means investors have the luxury to wait for the perfect investment opportunity before putting their money to work. Buffett's strategy may not be as glamorous or exciting as some of the get-rich-quick schemes out there, but it has proven to be incredibly effective over the long haul. It's a strategy that's built not on timing the market, but on time in the market. In conclusion, Buffett's approach to wealth building is a marathon, not a sprint. It's about understanding the value of businesses, having the patience to wait for the right opportunities, and the discipline to hold on to good investments for the long term. For Buffett, patience is the key to building enduring wealth. So, what are the key differences between Kiyosaki's and Buffett's approaches, you may ask? Well, let's dive right in. At the heart of Kiyosaki's strategy is the emphasis on financial education. He believes that the key to wealth building lies in understanding the nuances of money, investments, and financial markets. His approach encourages aggressive investment in assets such as real estate and businesses. He champions leveraging debt to acquire assets and create cash flow. This is in stark contrast to the more traditional safe route of earning a steady paycheck. On the other hand, we have Warren Buffett's approach. His strategy is rooted in patience and long-term thinking. Unlike Kiyosaki, Buffett is not a big fan of debt. His philosophy revolves around investing in companies with solid fundamentals and holding on to them for the long haul. Buffett's approach is about being patient, waiting for the right opportunity, and not being swayed by market fluctuations. Now, let's talk about the potential risks and rewards. Kiyosaki's aggressive investment strategy can lead to significant gains in a short amount of time. However, it also comes with higher risk. A downturn in the market could lead to substantial losses, especially if you're heavily leveraged. Buffett's approach, while slower, is often seen as safer. Investing in fundamentally strong companies and holding them for a long time can result in consistent, compounding returns. But it requires a level of patience and discipline that not everyone possesses. Moreover, the returns might not be as high as those gained from riskier investments. In essence, Kiyosaki's strategy is akin to sprinting, going all out in hopes of reaching the finish line quicker. Buffett's strategy is more like a marathon, maintaining a steady pace and focusing on making it to the finish line without burning out. While both approaches have their merits, they also come with their own risks. It's up to you to decide which path aligns with your financial goals and risk tolerance. The big question is, which approach is right for you? In the realm of wealth creation, there's no one-size-fits-all strategy. The path you choose will significantly depend on your risk tolerance, financial goals, and investment knowledge. Now let's dissect these factors a bit. Risk tolerance is all about how much financial uncertainty you can handle. If the thought of potential losses keeps you up at night, you may align more with Warren Buffett's slow and steady approach, which focuses on long-term stable investments. On the other hand, if you're comfortable with taking risks for higher potential returns, you might find Robert Kiyosaki's aggressive investment style more appealing. Next, let's consider your financial goals. Are you aiming for early retirement or building a nest egg for later years? If your objective is to accumulate wealth over time, Buffett's method of consistent saving and investing in value stocks might be your cup of tea. However, if you're looking to generate wealth rapidly, Kiyosaki's approach of leveraging debt and investing in real estate could be the way to go. Lastly, your level of investment knowledge can significantly influence your choice. If you're new to investing, the simplicity of Buffett's buy and hold strategy may be easier to grasp. But if you're well-versed in financial matters and ready for a more hands-on approach, Kiyosaki's strategy could be worth exploring. However, it's essential to remember that both approaches require a solid understanding of financial principles and the investment environment. So, whether you're a novice investor or a seasoned pro, never stop learning. Educate yourself, seek advice, and make informed decisions about your financial future. Remember, the path to wealth isn't a one-size-fits-all journey. It's about finding what works best for you. In the end, both Kiyosaki and Buffett agree on one thing: the importance of building wealth. As we've navigated the contrasting roads to riches, we've uncovered the fast lane of Kiyosaki, a route paved with high risks and potentially high returns. Then, we've explored the slow and steady path of Buffett, marked by patience, consistency, and calculated decisions. Each strategy carries its unique strengths and challenges. Kiyosaki's approach fuels the entrepreneurial spirit, pushing boundaries and embracing the unknown. Buffett's method, on the other hand, champions the art of patience, the power of compounding, and the value of thorough analysis. Both journeyers emphasize the critical role of financial education, an armor that empowers us to make informed decisions, navigate financial storms, and capitalize on opportunities. Regardless of the path you choose, it's your financial literacy that sets the compass and guides your journey. So whether you're a risk-taker like Kiyosaki or a patient investor like Buffett, remember this: the journey to wealth starts with a single step.